Hi, my name is John Palmer, Senior Vice President and Head of Real Estate Strategies at Westwood. I wanted to take a couple minutes and share my thoughts on the REIT market for the month of April, but as usual, I'll preface my REIT industry comments with a few observations about the macro. April proved to be a remarkable month for equity markets, perhaps the best month of the year, as the S&P 500 finished up 10.5% and the Nasdaq finished up an impressive 15.3% for the month. Investment grade credit was modestly wider at a roughly 75 basis point spread, and high yield came in around 260 basis points, both still near the tighter end of their 5-year ranges. We'll go deeper into the REIT performance a little later in the video. The equity market's performance this month was nothing short of surprising given the backdrop. The US-Iran conflict that began in late February has now stretched into its third month, and the Strait of Hormuz remains effectively closed. Oil prices climbed above $110 a barrel at points during the month, and nationally, gas at the pump hit $4.18 a gallon, the highest level since August of 22. Historically, oil shocks of this magnitude have triggered recessions and meaningful equity drawdowns. And yet, at its worst moment, the S&P 500 only pulled back about 10% from its highs before recovering sharply. The story here is that a generally strong Q1 earnings season led by big beats from Alphabet, Coca-Cola, and Caterpillar and others gave investors a reason to look past the geopolitical noise. AI-related spending also continues to be a powerful tailwind, with several of the hyperscalers raising their capital expenditure guidance meaningfully for the rest of the year. Switching to the economic side, the big data point of the month was the Q1 GDP advanced estimate, which came in at 2% annualized, a solid rebound from Q4's near stall of 0.5%. On the surface, that looks like good news, but the details underneath are worth paying attention to. A significant portion of that growth was driven by businesses front-loading imports ahead of tariff increases, which artificially inflated the inventory and investment figures. Also, consumer spending, while still positive, decelerated from prior quarters. So while the headline held up, the quality of the growth was uneven. The bigger concern, the one I'm closely watching, is that the Fed's preferred inflation measure, the PCE price index, surged to 4.5% in Q1, which is more than double the Fed's 2% target. That's a meaningful reacceleration from where we were just a few months ago, and it's being driven by a combination of tariff pass-throughs into consumer prices and sustained energy cost pressure from the Middle East conflict. The word stagflation is showing up in more analyst reports, and while we're not fully there, the economy is still growing and unemployment is holding steady. The directional trend is uncomfortable. Regarding the labor market, April's jobs data remained relatively firm. The unemployment rate is holding near 4.4%, and initial claims have stayed contained. The concern isn't that the labor market is breaking down right now. It isn't. The concern is what happens over the next few quarters if energy prices stay elevated and inflation continues to reaccelerate. On the monetary policy front, this week the Fed held rates steady at their April meeting, keeping the target range at 3.5 to 3.75%, which was widely expected. What was more notable was the level of dissent. 4 members objected to the meeting statement, the most dissents since 1992. 3 of those 4 opposed the forward guidance language that implied the next move would be a rate cut, while a 4th actually wanted to cut immediately. That divide tells you a lot about how difficult the Fed's position is right now. Markets have largely given up on cuts in the near term, with future markets pointing to 1 or 0 cuts through the year end. The other major policy development worth flagging is the Kevin Warsh confirmation process. The Senate Banking Committee held its confirmation hearing this week, and the path through the chair now looks clearer after the Justice Department dropped its investigation into Chairman Powell. Warsh is widely expected to push for a stronger inflation mandate and is likely to reorganize how the Fed communicates its forward guidance, which is worth watching carefully given how much markets have come to rely on that guidance over the past decade. It's bound to be very interesting. So with that macro commentary behind us, let's switch now to real estate. On the first slide, we show the 10-year Treasury chart since the beginning of the year. The 10-year started 2026 at 4.17% and ended April at 4.37%. So we've seen 20 basis points of yield increase since the beginning of the year. However, when you measure from the February 27th low of 3.94%, the yield change is closer to 45 basis points. Switching to REITs, on the next chart, you'll see the April performance for the MSCI US REIT Index. Generally speaking, REITs had a very strong month, posting a positive 9% return, taking their year-to-date performance to positive 13.2%. Next, I thought it would be helpful to put the April REIT performance in context with the broader market. On the following chart, I've broken out the S&P 500 into its 11 GIC sectors. As you can see, the REITs in the S&P 500 produced a top 4 sector return for the month of April. Not surprisingly, the tech and communication names led for the month. On the next chart, we highlight the April REIT market performance by property sectors. As I stated earlier, April was a very strong month for REITs, with every property sector posting positive returns for the month. Top performers included single-family rental, office, data center, and lodging, whereas manufactured housing and timber, while still positive, lagged for the month. Lastly, I thought it'd be helpful to show the change in valuations from the beginning of the year on a cap rate basis. As you can see on the last slide, implied cap rates for the most part have remained fairly steady on a year-to-date basis. However, the noticeable sectors would be all 3 of the residential property sectors: manufactured housing, single-family rental, and apartments, which have seen cap rates widen a bit, while data centers, self-storage, and shopping centers have seen a bit of cap rate compression. But overall implied cap rates for the REIT market currently sit in the mid-6s, which still remains a little wide to long-term historical averages. As always, thank you for your time, and if you have any other questions, please feel free to reach out directly to Westwood. I look forward to sharing additional updates with you in the future.